Hello, everyone, and welcome to Chapter 16, the Vasicek and the Gauss Plus models. Now, here's the thing, this chapter is actually the final one in the term structure series of your FRM Part 2 curriculum. Okay. So far, we have covered a lot of things. We started with arbitrage pricing frameworks, we talked about expectations, convexity, and how shapes of yield curves are formed. Then, we explored the structure and behavior of interest rate models. And if you remember, that included their volatility and distribution characteristics as well, right? And now we will try to apply some of that knowledge in understanding two of these very important models. Vasicek we have already introduced earlier. Okay. So again, it has been discussed in this chapter, and as you know that it is a foundational one factor model, and we are going to introduce Gauss plus model for the first time. And this model actually takes things to a whole new level with its multi-factor approach and you can say dynamic volatility structure, which we'll discuss in detail. So in this lecture, you'll not only see how interest rates can be modeled, but you'll also see how these models can be calibrated, how they can be interpreted, and how they can be used in the real world. Okay. Now, for in the real world, for what? For things like bond pricing, we have already discussed this application also earlier when we started the term structure chapters. We discussed applications like bond pricing, of course, risk management, even macroeconomic analysis can be done. Then there is a particular application of the Gauss plus model which has been discussed in the appendix of the GARP text, but it's not included in the part of the learning objectives. Okay, basically it's about the trading part, so we'll not discuss it. Okay, and we'll just cover what is relevant to the learning objectives. Okay, so let's get started. These are the learning objectives. We have the first one, describe the structure of the Gauss plus model and discuss the implications of this structure for the model's ability to replicate empirically observed interest rate dynamics. Then compare and contrast the dynamics, features, and applications of the Vasicek model and the Gauss Plus model. See, the first learning objective is covering the structure of the Gauss Plus model directly. But before that, since, see, in the second learning objective, since we have to discuss the differences also between Vasicek and Gauss Plus. So before this first learning objective, we'll give a precursor to the to this learning objectives. So we'll reintroduce the structure of the Vasicek model, which we have done earlier also, right, in the previous chapters. Then the third learning objective, calculate changes in the short term, medium term, and long term interest rate factors under the Gauss plus model. And finally, the last learning objective of this chapter, explain how the parameters of the Gauss plus model can be estimated from empirical data. Now, a lot of aspects of the learning objectives in particular have not been covered properly even in the GARP text. So we have tried to improvise, we have tried to give some additional data as well as some additional points also wherever possible. Okay. Okay, let's start. So we'll start by understanding the fundamental models, the two of them, which are used to describe how these interest rates evolve over time. And see, interest rate modeling is a very important aspect, as we have seen all through the initial chapters of term structure modeling. So the interest rate modeling is very important, a very important aspect of financial risk management, as we have seen in the previous chapters. It helps in pricing bonds as well as derivatives, and it also plays a key role in managing interest rate risk. Okay, so there are two widely used models for term structure modeling that we'll be discussing in this lecture. One is, of course, the Vasicek model, and which is the earliest and one of the most fundamental models for interest rate evolution. And then we have the Gauss plus model, which is a more advanced model that kind of builds upon the Vasicek framework only. Okay. So let's start with the Vasicek model. So we're just introducing it right now. Okay. Now the Vasicek model is an example of a mean reverting stochastic process. Okay. Now what does this mean? What does this imply? The mean reverting stochastic process. Essentially, this model assumes that the interest rates, they tend to move towards a long run mean. Okay, a long run average, a long term average over time, you can say. So this property actually makes it quite useful for risk neutral pricing. It makes it quite useful for estimating future interest rates also and forecasting. the yield curves as well. However, there is a well-known limitation of this model. It can sometimes predict negative interest rates. So while this might be a useful mathematical feature, but as you all know, it is not always realistic in practical financial markets. Very rare we see negative interest rates, especially when you consider normal financial conditions, right? Normal economic conditions. Now, to overcome some of these limitations, you can have the Gauss plus model. It was developed to overcome some of these limitations. And this model actually enhances the Vasicek framework by adding and introducing some additional factors which allow for a more flexible and accurate representation of real world interest rate behavior. So instead of relying on a single factor like the Vasicek model, it actually incorporates multiple sources of risk. So that is why it is better suited for capturing the movement of interest rates across different maturities. Okay. So because of these improvements, this Gauss plus model is particularly valuable for bond traders and risk managers, okay, who require a more precise model to assess and manage interest rate risks in, you can say, dynamic financial environment. So in this particular side, in summary, we have two key models, right? We have the Vasicek model. We see that it's simple, but it has some limitations. And we have the Gauss plus model, which is more advanced, captures multiple factors, and it provides more realistic term structure of interest rates. Okay. Now, again, let's discuss this Vasicek model in a little bit more detail. So Vasicek model, as I said, is a one factor model. Okay. Now, what makes it special is that instead of just letting interest rates drift around randomly, the Vasicek model assumes that they kind of have this tendency to pull back towards a long-term average, which we discussed in the previous slide as well. So that's why it's based on something called this mean reverting stochastic process, which, if you see in simple terms, it simply implies that interest rates don't just wander off forever, right? They move for sure, right? But they tend to return to some equilibrium mean reverting value over time. And this whole idea was introduced by Aldrich Vasicek in 1977, which is why it's called the Vasicek model, of course. Okay, now let's try and go, uh, I'll say not deeply, but just get a little bit into the math behind it. Okay, so don't worry, I'll just try to keep it as simple as possible. So mathematically, it is actually uh, based on something called as the Ornstein-Uhlenbeck process. Okay, so fancy name, of course, I know, but all it really means that the interest rates change in a way that kind of balances two things: a natural pullback to the average rate and random market fluctuation. So this is how the equation looks like. dr is equal to k times theta minus r multiplied by dt plus sigma dw. So let me just break down this a little quickly. Now this r, what are we talking about right now? R is just the current short-term interest rate. Okay, so of course dr is the change in the short-term interest rate. So k is how fast, k is the speed of mean reversion. So k is how fast the interest rate is getting pulled back towards the mean, okay, towards the long-term average. Theta is that long-term average, okay, the level of interest rates that we want them to return to. Sigma is the unpredictability in the interest rate movement, so basically volatility. And what is DW? DW, as of now, you can just, we'll see the calculations also. In fact, we have calculated DW earlier also, and we have taken in the previous chapters when we introduced the Vasicek model. So just to introduce this random market noise, okay, we used the DW factor and we also dealt with the calculations as well and some of the simulation trials as well, right? And of course, dt is the short interval of time which we are talking about. So why does this all matter right now? Why does Vasicek model? I mean, We know that Gauss plus model is much superior. So why does this Vasicek model, sorry, matters? See, Vasicek model is super useful in a simple way to price bonds, to manage risk, okay, and to forecast yield curves, but in a simple way. So if you're dealing with interest rates, we need to start with how to, understand and how to know about this model. The basic idea we should have we should ideally be knowing about. Okay, now characteristics of Vasicek model. Now again, I'm repeating this again and again. So at its core, the Vasicek model is built on the idea of mean reversion. Okay, so if you imagine the interest rates as a pendulum, okay, if they go too high, they'll eventually start coming back down. And if they drop too low, they'll start rising again. So this model assumes that over time, these rates, they gravitate towards a long run average, which we just in the previous slide only in the mathematical formula, we called as theta. Now, another key assumption that we see in the Vasicek model is that interest rates follow a normal distribution. Okay, now this is important because it means that interest rates can take any real value, including negative ones. It sounds a bit unrealistic, right? Because in reality, interest rates, as I said earlier, also, they usually don't go negative except in some extreme cases. But mathematically, the model allows for it. So, why this Vasicek model is quite attractive, as I said in the previous slide also, mathematical simplicity. This is one of the main reasons that it is based on the Ornstein-Uhlenbeck process, and it is quite simple, a straightforward model. Okay. And this process makes the math, this Ornstein-Uhlenbeck process, it makes the math a lot easier. Okay. So this becomes a huge advantage when it comes to pricing bonds and modeling different kinds of yield curves. Now, here you can say it gets a little better also sometimes in the terms of its solutions, because it comes with something called as closed form solutions. So what does this closed form solution mean? A closed form solution is just a way of saying that we can calculate future interest rates and their fluctuations, okay, using simple plug and play formulas. No complex simulations are required. Okay. So this is the expected future rate formula. If you want to see the mathematical formula, the expected future rate is actually this: ERT is equal to R naught multiplied by e raised to the power minus KT plus theta times 1 minus e to the power minus KT. So this tells us where the interest rate is expected to be at some future time based on where it started, okay, based on R naught, and how quickly it converges to the average. And this is the formula for variance. Variance of the interest rates is equal to sigma square by 2k, and RT, when we talk about RT, of course we are dealing with short-term interest rates. So this is the formula for variance, sigma square by 2k multiplied by 1 minus e raised to the power minus 2k. Now, when we say closed form solution, see why this closed form solution is important with these two mathematical formulas, because it makes it quite easy to forecast the future rates, as I said, okay, and calculate things like bond prices or say derivatives values uh, more quickly, more efficiently, you can say, okay. Now, what are the advantages? Since we have to compare Vasicek with the Gauss plus later on, so we should at least know some of the advantages of the Vasicek model. So first, of course, aside from being mathematically convenient, it also comes with some more advantages: easy to compute, closed form solutions, which makes the bond pricing and yield curve modeling much more straightforward, much more simple. Okay. Another advantage, of course, is its popularity. It is widely used actually. Okay, it is widely used in practice, especially for risk management and pricing interest rate derivatives like swaps, caps, and floors, and other risk management instruments, derivatives. And finally, it actually lays the groundwork for more advanced models like the Gauss plus model that we're going to discuss, and also the Hull White and CIR models, which were also discussed in some earlier chapters. Okay. Now, since we have discussed advantages, we also should also look at the limitations. So obviously, whichever model we talk about, irrespective of its complexity. Okay, even if it's very complex, it is multiply uh, applicable to different situations, but still it will be not be perfect. Okay, so Vasicek, of course, is quite simple. So in any case, Vasicek cannot be perfect, right? So it has its share of limitations. So first, it struggles to capture the complexity of real world yield curves. So interest rates don't always follow a simple pattern. Okay, and the model sometimes falls short in predicting their exact movement, exact complex movement. The second, as we mentioned earlier, it allows for negative interest rates, which can be unrealistic. Okay, so how many how many times we see people paying banks to hold their money, right? So that's why I said, I mean, and in part one also we have discussed this issue that, in fact, if you remember, those who have done part one with us, there was a GARP sample paper question uh, based on replicating portfolios, okay, in valuation and risk models chapter, replicating portfolios, which we solved using the replicating portfolio method also, but we also solved using the simple discount factor method also. And I asked the candidates the in the class that uh, what do you think is unusual about this discount factor? Because that discount factor itself was becoming greater than one, right? Which means that the question, the numbers were not chosen, to reflect practical ideas that interest rates generally should not be negative, because a discount rate greater than one will mean negative interest rate. So, as I said, how many times we see people paying banks to hold their money? We have seen examples of Japan. Okay, there was a relatively longer period in Japan, but those are special circumstances. Okay, so this is a limitation. Now, another limitation is that this model assumes that some of the key parameters, like that mean reverting parameter, right? The parameter which was dictating how fast the interest rates were reverting to the average or how much they were fluctuating. They stay constant over time according to the Vasicek model. But in the real world, financial markets change. Okay, they are much more dynamic. Things change, policies shift, investor sentiment fluctuates, right? So assuming these parameters remain fixed is not always the best approach. Okay. Another big issue is that it oversimplifies the yield curve. So the Vasicek model is the single factor model, which means that obviously that it assumes that all rates move together perfectly or with a predefined relation. I'm not talking about a perfect positive correlationship, of course, but as you remember, the problems with single factor models that we discussed in part one also, right? With the problem with single factors was that they only assume single factors. They probably, some of them assume only a linear relationship, right? So this is a problem. Okay, it is possible that in reality, short-term rates and long-term interest rates may not always behave in sync or may not always behave according to a particular predefined relationship. Okay, so this is a disadvantage, and of course, one of the disadvantage which I have not mentioned explicitly in the bullet points in the slide, but I just tell you that okay, it does not take into account some of the macro trends or some monetary policy changes. So even though it's a solid theoretical framework, it does not always reflect what's happening in the broader economy. Okay, now let's see the applications. Of course, you have, even with these limitations, you have the applications in bond pricing, helping the financial institutions in predicting how the bond yields evolve. Then, of course, in risk management, where they help measuring and hedging interest rate risks. And then derivatives pricing, so used for pricing things like interest rate swaps, caps and flows, as I said earlier, and some other instruments as well. And most importantly, perhaps most importantly, it serves as a foundation or benchmark for more advanced models like Hull White, Gauss Plus, CIR. Okay, those models have refined some of the limitations of the Vasicek model. So, what is the overall takeaway over here? That the Vasicek model, till now what we have done, that the Vasicek model is a very important building block in financial mathematics, if I may say. It may not be perfect, but it has laid the groundwork for more sophisticated models that we use today. And of course, as the financial markets evolve, so do the models. And so, if suppose you discuss interest rate modeling with someone, you'll know exactly what they mean. When they mention the evolution of the interest rate term structure with the interest rate modeling with the Vasicek model. Okay. So now let's start the Gauss plus model. So we've covered the Vasicek model and we'll move on to this more advanced Gauss plus model. Now this model takes everything what we have learned about the Vasicek model and it levels it up. It kind of levels it up, you can say, by introducing multiple factors that interact with each other. Okay, so it's a multi-factor model. It improves upon the Vasicek model and instead of relying on just one component, it introduces three interacting factors that work together. We have the short-term rate is one of the factors. This factor reacts quickly to changes and is heavily influenced by central bank policies. Then you have the medium-term factor MT. This factor captures market expectations and it responds to broader economic trends. And finally, we have the long-term factor, which reflects fundamental macroeconomic trends, things like long-term inflation expectations, real interest rates, productivity growth, GDP growth, etc. So how does this work? See, each of these factors follows a mean reverting stochastic process. Each of these factors, okay. But unlike the Westcheck model, where there is just one uh, process, you can say, the Gauss plus model introduces cascading interactions between these factors, where each factor influences the next over different time horizons, and we'll see this in a subsequent slide. Okay. Now, for those, of course, who are more curious about the mathematical part, okay, although the derivations and the detailed dynamics are not a part of the curriculum, only the application, plug and play application is there, which we'll discuss. But here is how the mathematics works behind the Gauss plus model. So let's start with the short term rate dynamics. So this is the formula for the short term rate dynamics. The short term rate is actually drifting. You can see this is the change in the short term rate. It is drifting towards the medium term rate MT at a speed which is governed by alpha R. Okay, so this is quite similar to the first part of the best check model only, right? Now we have the medium term factor dynamics. So this is the formula for medium term factor dynamics. This is much more complicated than the first formula. Now this medium term factor moves towards the long term rate LT with a mean reversion speed of alpha m, while also being influenced by the volatilities and some random fluctuations through these Brownian motion terms. Okay. And finally, we have the long-term factor dynamics. This has a simpler formula as compared to medium, but more complicated as compared to short term. So this long-term factor reverts very slowly towards a very long range, a long run expected value mu, which actually incorporates some long run expectations also and some risk premiums also. Okay. So what do these terms actually mean? Let's discuss that also, some of the key terms. So alpha R, alpha M, alpha L, they are the speed of mean reversions for short, medium, and long-term factors respectively. Mu is the long-term equilibrium level, which incorporates risk premiums. Sigma M, sigma L is the volatility parameters for medium and long-term factors respectively. And rho is the correlation between medium-term and long-term factors. And of course, these DW1T and DW2T, these are independent Brownian motion processes which introduce some kind of randomness into the picture. Okay. Now, how do these factors interact? Okay, cascading interactions. Now, the short-term rate, RT, it reverts quickly to the medium-term factor, MT. Okay, so short-term rates adjust quite quickly to align with medium-term expectations. Medium-term factor, they move, it moves, sorry, more gradually towards the long-term factor LT. And the long-term factor reverts quite slowly to its equilibrium level mu. So in simple terms, it's like a domino effect, you can see. Short-term rates, they are quickly adjusting to medium-term expectations, and then medium-term rates, they slowly align with the long-term trends, which, and of course, the long-term factor aligns even more slowly towards the equilibrium value. Okay. Now it's important to understand that these medium-term rates actually, since they capture the market expectations, the shifting market expectations and economic cycles. So the medium term factor also captures the economic cycles as well, right? And the long term factor, it responds quite slowly to structural macroeconomic trends. So what is the result of these interactions? The result is that you have a dynamic model that can simultaneously capture short term policy effects, medium term economic expectations, because we saw earlier that short term rates are very quickly influenced by central bank policy decisions. So this model can capture short term policy effects, medium term economic expectations, and long term macroeconomic trends as well, quite dynamically. So that is the benefit of the Gauss plus model. Now, the correlation between the factors, why it matters actually, if you see, uh, things actually get more interesting because in real world markets, interest rate changes, they are not independent across maturities, right? So Gauss plus model actually accounts for this by introducing correlation parameter rho. Okay, if rho is high, then medium and long term rates move quite closely together. Okay, but if rho is low, then short term changes have, you can say, minimal, either little or no impact on long term expectations. So this feature actually allows the Gauss plus model to reflect real world dynamics, unlike the Vasicek model. So it's an improvement over Vasicek. Okay, because Vasicek model was assuming a perfect correlation across all maturities or a single formula, right? So if you have one of the rates, you have a predetermined relationship with the other rate also. That is what the assumption of Vasicek was, but that is not the case. Okay, and Gauss plus captures these interactions quite nicely, quite efficiently. Now, this one is a major upgrade, I'll say, in the Gauss plus model. Dynamic volatility across maturities. So a big win or a major upgrade. The ability to account for changing volatility across different maturities. Because in real world markets, the short term rates, they tend to have low volatility because central banks actively stabilize them through policy interventions. Medium term rates exhibit higher volatility due to shifting market expectations and some macroeconomic shocks. Long term rates show declining volatility because they are influenced by structural factors like inflation and long term growth. So, what's actually cool about this? Which we'll see later on. In fact, when we see the estimation of parameters, we'll see the shape also. So the cool thing is that the Gauss plus model captures this hump shape volatility pattern that we see in the real world bond market data. Okay, something which the Vasicek model simply cannot replicate. Okay, now what are the implications? Let's explore how the Gauss plus model transforms our understanding of interest rate behavior by addressing the limitations of the Vasicek model and in isolation also. So, of course, we see better representation of yield curves. The Gauss plus model provides a more flexible and realistic representation of yield curves. So, while the Vasicek model can only produce simple upward or downward sloping curves. And remember this part, the comparison between Vasicek and the Gauss plus, and we are doing this again and again. In fact, till now, the introduction part of Vasicek and then Gauss plus. Uh, in these 13, 14 slides only, we have covered a lot of comparison actually, if you see between Gauss plus and Vasicek. And there are three separate slides where, based on the context, we are comparing Vasicek and Gauss plus once again properly in detail, because this comparison is a very important part of this chapter. Okay. So, of course, the flexibility of the Gauss plus model allows for a more accurate fit to real market, you can say, bond data. Then, of course, it captures the hump shape volatility. It captures the market volatility patterns where you have low short term, peak medium term, and then stable long term volatility. Then, of course, more accurate policy and shock response. So, this is again a critical advantage of the Gauss plus model, the responsiveness to policy and economic shocks. So, at short-term levels, it reacts as soon as possible, quite quickly and accurately to central bank policy changes. And over the medium and long term, it incorporates the effects of business cycle as well as inflation trends, which gives a more realistic reflection of the markets. And we have improved pricing of bonds as well as derivatives. Okay, so it of course enhances pricing accuracy for bond segment as well as derivative segment as well. Okay, it models the bond price movements across various maturities with much greater precision, and it also improves the pricing of derivatives like these instruments, which make sure that more reliable valuations are available in the financial markets. Now, as I said, the comparison will be made more clear as we move on to the subsequent slides. We have three slides where in the first one we cover in terms of the key dynamics, their distinctions. I mean, we are just comparing them. So we have the equation of the Vasicek model, single equation, and in this case we had three equations, right? In the as far as mean reversion is concerned, the Vasicek model, of course, it assumes mean reversion towards a long-term mean theta, long-term fixed mean theta. And the Gauss plus model, it introduces a cascading kind of mean reversion process, okay, to mu finally. Short-term rates were reverting to medium to long, then long to mu. Then stochastic component, if you see, you had a single Brownian motion there also, DW, right? Okay, so randomness was kind of uniform across different maturities, but you have DW1 and DW2 in Gauss plus mod. So you have multiple Brownian motions. Okay, and there is a separate term for correlation also between medium and long-term factors. Then for the speed of adjustment, you had K, which was affecting how the rates were or how quickly the rates were reverting to equilibrium in the Vasicek model. Whereas in the case of the Gauss plus model, we can have different speeds for different maturity rates. Okay, so you can say that for different maturity segments, you have different mean reversion speeds also. Then for the assumptions regarding volatility, this is important, of course, like the other points. The Vasicek model, it assumes a constant volatility, sigma. Whereas the Gauss plus model, it corrects this issue by adopting a time varying volatility. um, you can say a time varying volatility structure where you have different volatilities for medium term and different volatility for long term. Okay. And finally, see, these 2 points I have separated, although there was they could have been mentioned together in a single point, but I've separated these 2 points. Term structure of volatility is actually, I think it deserves its own mention, because the Vasicek model, it produces a downward sloping volatility term structure, which implies that the volatility declines as maturity increases. That is the that is the implication of the Vasicek model. But Gauss plus model, okay, it actually generates a hump shaped volatility structure. So again, this limitation is also corrected because it generates a hump shaped volatility structure which better aligns with real world bond market data. Okay. So overall, in multiple ways, Gauss plus model is actually addressing the limitations of Vasicek by incorporating multiple factors, dynamic volatility, okay, improved modeling of real world interest rate behavior. So it's much superior as far as the framework is concerned. It is much superior for capturing in real world interest rate modeling or dynamics, you can say. Okay, now with respect to features, of course, the number of factors in Vasicek were one. So same points in some of the slides have been repeated. If you see from the previous slide, this point has been repeated. But since we are comparing again, I'm saying it is very important that you are able to internalize all these ideas and the comparative analysis properly between these two models. That's why we are repeating some of the points again and again, okay, in different contexts. So now we are discussing in the context of features. So this uses a single factor which focuses on the short-term interest rate, whereas the Gauss plus model introduces three factors. You have the short-term rate factor, medium-term rate factor, and the long-term rate factor, which of course allows for a more, you can say, more complex or a more nuanced analysis of the interest rate dynamics. Then distribution. See, both the models. Now here we have similarities also. Okay, this Vasicek as well as Gauss plus model, they both assume a normal distribution of interest rates. Okay, and just to the distribution is same, but since it's called the Gauss plus model, that's why I have in the bracket I have mentioned Gaussian over here, which automatically implies that the change in rates, they follow a Gaussian curve with predictable kind of variations. Okay, now as far as the possibility of negative interest rates is concerned, that Vasicek model allows negative interest rates. Okay, theoretically it allows, but Gauss plus model, even though it allows the possibility, but still that can be minimized. That possibility can be minimized or can be mitigated through the mean reverting structure of the Gauss plus model. Okay. Now you have a simple, uh, simplistic approach, you can say, with very limited flexibility when you are modeling the yield curve in the Vasicek model using the Vasicek model. And on the other hand, the Gauss plus model allows for more realistic dynamics and it adjusts for different slopes and curvatures in the yield curve, which of course makes it a better fit for complex financial instruments. Then finally, when it comes to risk premium modeling, the Vasicek model's approach is quite limited, whereas the Gauss plus model incorporates risk premium into the long term interest rates, which makes it much more comprehensive. And finally, in terms of applications, also let's compare. So since we have explored the features and the dynamics, let's also compare in terms of applications. So Vasicek model and Gauss Plus both are used in bond pricing. The Vasicek model can price bonds, yes, but it's not very accurate for long-term bonds because of its limitation. Whereas the Gauss Plus model is better suited for pricing or for more accurate pricing, you can say. Okay, and then when you are modeling the yield curve, as we saw that it is quite simple and it cannot capture steep curves or humped curves. Okay, it struggles to capture those kind of shapes. Whereas the Gauss plus model is better suited for realistic yield curve modeling. Then risk management can be, the Vasicek model can be used in basic models, basic risk management models, but it cannot handle complex models. But since the Gauss plus model captures volatility at different maturities, it is also better suited for advanced risk management models. Vasicek model has very limited, very little application in derivatives pricing, and it struggles with capturing the volatility smile, okay, which is actually coming in the next chapter. The next chapter immediately after this in the current curriculum is actually volatility smile. Okay, so this volatility smile is actually quite important for pricing options. If you learn that in the next chapter, many of you already might be aware of volatility smiles. You might be doing this chapter after volatility smile, so it's completely actually good. Okay, I'll say. And uh, you might be able to appreciate this point even more. And Gauss plus model can be used more effectively for interest rate derivatives because of its multiple factors. Finally, the Vasicek model is less useful in macroeconomic analysis because of its simplicity. And the Gauss plus model it provides valuable insights into economic cycles and monetary policy impacts, which of course will make the Gauss plus model a preferred choice in economic research as compared to Vasicek model. Okay, now let's see the Gauss plus model in action with an example. So we're going to walk through how to apply the model step by step. And as I said earlier, also plug and play. So there is no detailed derivation as such. You can just use the formulas directly. And we can use some sample values for all the key parameters. So first, let's assume the following parameter values. The mean reversion speeds are set as alpha r is equal to 1.08, alpha m is equal to 0.62, and alpha L is equal to 0.018. Volatilities for the medium and long-term factors are given as 1.10% or 0.011. And for long term, it's 0.95% or 0.0095. Now, the correlation between the medium term factors and the long term factors rho is actually 0.215. It has been assumed. And we are, say, simulating weekly changes. So our time step will be 0.02, which is the value of 1 week, which is about 1 week in years. Okay, if you want to convert into years, 1 week into years, we'll express it as 0.02. Now we also have to assume the numbers for the current state of interest rates. So we'll start off with these rates. The short-term rates 2.95%, medium-term rates 3.45%, and long-term rates 10.45%. And finally, the long-term mean rate, the equilibrium rate, is 10.5%. Okay, these are our assumptions. Now, step one, what do? We don't start with the first short-term rate formula. No, the first thing, it's better, although the random shocks are not required in the first formula, it's better to generate the random shocks first. Okay. So let's assume that Z1, the standard normal variable, comes out to be 0.8 and Z2 comes out to be negative 0.45 in our trial. So standard normal variable, just like we were doing in earlier chapters to simulate randomness. So from these, we compute the two Brownian motion terms. We have dw1 subscript t. We calculate it as 0.1131, dt is 0.02, and dw2 is negative 0.636. Okay, so we have calculated our random shocks, we have generated them. So these, we are going to feed the random shock values into our medium and long-term rate equations. As I said, not required for the first one, but it's better to generate them first. Now moving on to step two, we calculate the change in the short-term interest rate and we'll update it. Okay. So we use this formula, of course, the short-term change, the formula that we did earlier, the first formula. So let's plug in the numbers. We just plug in the assumed numbers, whatever assumed values we had for alpha r. Okay, the short-term interest rate, medium-term interest rate, 1 week, all these numbers we plug in. So this is the first step. And the second step, you can see we get 0.000108. Okay, so this is the change. Remember, this is dr, not r. So now we have to update the short-term rate. Okay, so RT plus 1 is equal to the earlier, the existing, the starting rate plus the change in the rate, which becomes your new updated short-term rate 2.9608%. Then, of course, we have step 3, the medium-term interest rate change, and we'll update that also. If you remember, the formula was the most complex for the medium-term rate, the longest formula. Again, you can just verify the calculations yourself. I've just plugged in the numbers. Okay, you can verify the calculations yourself. You can either use the video or you can use the PDF that we'll provide you. So, so this is the idea. Okay, the first part, of course, is the mean reversion part, and then you have the stochastic part. So we've calculated them, And we get the change, the total change in the medium term factor as 0.000451. And of course, this is the change, not the rate. So the updated rate is the existing, the earlier, the starting rate of 3.45% plus the change of, you can see 0.000451, or you can say 0.0451%. Okay, so whichever way you want to call it. So it will become 3.4951%. Okay. And finally, step 4, you have the computation of the long-term interest rate change and then its updation. So long-term interest rate change, DLT, is given by this equation, which comes out to be, the first part is the mean reverting part and then the stochastic part. The stochastic part is smaller, is simpler as compared to the previous equation for the medium term. And we get finally 0.001075, which gives us the updated long-term rate as 10.5575%. So in the exam, if you are asked the question of application of Gauss plus model, most probably, okay, because the derivation and dynamics are not discussed in detail, of the equation at least. So most probably, this is how you might get the question. So this is how we simulate a 1 week update using this Gauss plus model, which factors in mean reversion, volatility, correlation also, and randomness to get a more realistic picture of how the interest rates are actually evolving. Okay. Now, since we have seen how the Gauss plus model is actually working and how we plug in the numbers, we can also look at something which is equally important, how the parameters are actually estimated from the market data. Okay. So Gauss plus model is not just a theoretical model. Okay. It is meant to reflect how the interest rates actually behave in the real world. This has to be very clear in your mind. Till now, whatever we have discussed, this has to be very clear and very obvious in your mind, right? So that is why, for reflecting this behavior, we need to estimate its parameters. Okay, so what parameters? If we want to estimate its parameters, then only we can, use those parameters. So we actually use historical market data to estimate the parameters. What kind of data we can have? Bond yields, we can have forward rates, we can have observed market volatilities. Okay. So what are we estimating? You can think of the whole estimation process in 3 stages. You can have the mean reversion parameters first, then volatility and correlation parameters next, and finally the long-term equilibrium rate, which we of course write as mu. So these are the 3 stages. You can, I mean, it's not necessary that these will be the 3 stages, but this is the best way to approach the estimation process. Okay. So let's start with the first stage, the mean reversion parameters. Okay. Now the mean reversion parameters, they are basically telling you how quickly each of these rates, the short term, medium term, and long term factors, they actually pull back to their target levels. And we estimate them using regression. So here's how it works actually. We basically look at how the yields on different maturities change in response to changes in some benchmark rates, like the 2 year rates and the 10-year rates, or you can say the 2 year zero coupon yields and the 10-year zero coupon yields. Now, by regressing the change in, say, the short term rate on changes in the medium term and long term rates, we can get a sense of how strongly each of these factors pulls on the other. Okay. And what's actually really useful here is that these regression results, they do not depend on volatility, which means that we are isolating just the deterministic part of rate movements. Okay, the underlying structure, you can say, of how these factors revert to each other. So practically, if you want to see a simplified approach, there are four straightforward steps. First, you will choose a proxy for the short-term rates. Usually, it is the federal funds target rate. Then you will regress the changes in that short-term rate on the 2 year and 10-year yields. Okay. In fact, if you see in terms of volatility, when you see the shape of the volatility, the hump shape, you'll realize that sometimes even a medium term can be treated as 15 years period also sometimes. But of course, over here, when we are regressing the changes, we can say that okay, one of the medium term rates can be the 2-year rate and the long term rates can be the 10-year rate. Now from that we extract alpha r, the speeds, alpha r, alpha m, alpha l. Okay, and finally we have to validate. We make sure that the coefficients from the model, they have to line up very closely with the actual relationships that we see in the data. That's important. Now let's move on to the volatility and correlation parameters, sigma m, sigma l, and rho, the second stage. Okay, I said earlier also, it's not necessary that you have to divide it into 3 stages, but this is how the text has been structured. Okay, and it makes it more convenient and more more cohesive if you see, because the mean reverting parameters should be taken as a single lot. Since volatilities have correlation, the medium term and long term volatilities also have a correlation with each other. So these three can be taken together. Now, these are super important because see, the interest rate volatility, sigma m is not equal to sigma l, right? It will be different. So Gauss plus model is accounting for this fact that you don't have constant volatility. You have different volatility. What was Vasicek doing? Vasicek was assuming constant volatility. Okay. So how they are done? How the estimation is done? Volatility is estimated. We start by examining the term structure of volatility in real markets. How much the interest rates tend to fluctuate at different maturities. Okay. So these can be based on two things. You can have historical or you can have market implied volatilities. Either you can have historical volatilities or you can have market implied data. So basically, the historical will be what you have actually observed. Okay, the observed variability you can say in the interest rate data historically. And market implied volatility means what the market expects, which can be extracted from things like options and interest rate, other interest rate derivatives. Then we use a kind of an optimization process where we tweak the model's this volatility and correlation parameters until the patterns it produces closely match with what we see in the data. Okay, and this rho, that's the correlation between the medium term and long term factors, it tells us how closely the movements in those parts of the curve are actually linked. So high rho will of course mean that medium and long term rates, they move together and there is a correlation between the volatilities as well. And of course, a low correlation will mean that they behave more independently. We saw that in an earlier slide also, okay, where we saw the case with high rho and low rho. Now, volatility is produced by the model. They have to be calibrated to match market behaviors across material. So this is a feature which you'll see for all the parameters in the Gauss plus model. It's important to, try and match market behavior as much as possible. And finally, we estimate the mu, which is the long-term equilibrium value of the short-term rate. It represents uh, where we think the short-term rate is headed over a very long horizon. Okay, so it captures the underlying economic fundamentals like inflation expectations. We discussed this earlier also, right? Productivity growth. And it also includes a risk premium. Okay, so to estimate mu, we actually take a slightly different approach. That's why you can see it's in the third stage. We compare the model's predicted yields to actual market yields across a wide range of maturities, and then we adjust the value of mu until the SSE. Now, if you remember from part one, you'll remember SSE, the sum of squared differences, the sum of squared errors between the observed yields and the model implied yields across all maturities, okay, is minimized. So we again over here also we minimize SSE. which ensures that the model's yield curve will align as closely as possible with the real world data across all maturities. Okay, let's now talk about where all the data comes from when we are estimating the parameters for the Gauss plus model. What are the practical sources and observations? Because this is not guesswork, right? We are relying on real world data to ensure that the model mirrors the actual market behavior. So where do we start? So first up, we have short-term interest rates. For this, of course, we use the federal funds target rate, well recognized benchmark, and acts as a solid proxy for the short-term rate. Next, for the medium term and long term factors, you have the forward rates. We look at the forward rates, things like 2 year and 10-year forwards. These forward looking instruments give us a sense of where the market thinks rates are headed. Okay. And they map nicely to the M and L components in our model. And then we are also bringing in data from zero coupon bonds, particularly their prices and the yields we can derive from them. Okay, these are super useful, of course, because they let us observe interest rate behavior across all maturities, across a wide range of maturities. And usually you will pull out this data from reliable, trusted sources, okay, like central bank or large financial institutions. Then it's also important to make sense of how all these prices or sorry, they behave in a time series context, because when you are using practical sources, empirical observations, you are using and matching them, you also need to understand the time series context, okay, and the time series interpretation. So the short term rate, of course, since they are linked to the federal funds rate, they will adjust daily. So they reflect what is happening right now in monetary policy. Then comes the medium term factor. This one is aligned with the 2 year forward rate, and you can say it acts like kind of a crystal ball. Okay, it gives you a glimpse of where the short term rates might be headed in the future, the outlook. Okay, and finally, you have the long term factor L, which is based on the 10-year forward rates, and it captures expectations over a much longer horizon. Again, I'll repeat things like inflation outlook, growth projections, and so on. Okay. And based on these practical sources, we also need to understand, we need to look into some key observations, some key patterns that we have seen in the market data, particularly from 2007 to 2022. Now, one interesting thing, at the medium term factor M, it actually tracked the 2 year forward rate very closely during high interest rate environment. So that link is pretty solid. Okay. Now, during the times when the interest rates were close to zero, especially near the uh, zero lower bound, the medium term factor turned deeply negative. So this acted like a kind of forward shadow rate, which reflected the market's pessimistic outlook on future rate interest rates hikes by the central banks. Okay. And one of the most striking observations came in early 2014. The medium term factor began to rise steeply, well before the Fed actually raised the interest rates 2 years in advance. So it had anticipated the Fed's rate hikes nearly 2 years before they happen. Okay. Now let's come to the final part of the final 3, 4 slides, the final part, the final section of this particular chapter. And let's discuss this in detail, because again, there's a problem that they have not given the exact extraction, exact estimation process, but a very good idea has been given. Okay, so let's dive into how this Gauss plus model parameters are actually estimated in practice. And this is where the validity also, after that, this is where the model will show its real strength. Okay, now the estimation process, of course, does not try to do everything at once. It proceeds in stages, and you can see that for this entire discussion, I only have two graphs actually and one table at the end. Okay. So because this graph is very, very important. So let's begin with this graph and let's end also. I mean, for this particular slide, we'll conclude with this graph only. So this plays a very important role in the estimation. Okay. Fitting the mean reversion parameter. So this bar graph, entire graph actually summarizes how different bond maturities they respond to changes in key benchmark yields and how well the Gauss plus model captures that behavior. So in the x-axis, you have the term structure with maturities from 1 to all the way up to 30 years. Y-axis shows the regression coefficients. Basically, how much the yield at each maturity changes in response to the movement in the 2-year and 10-year zero coupon yield. Okay, so we are doing a regression on the 2-year and 10-year zero coupon yield for different yields at each maturity, in fact. Okay, now this solid brown or red bar, brown in fact we can call it, it represents the empirical coefficient from regressing the yield changes of different maturities on the 2-year yield only. Okay, this hatched red bar shows what the Gauss plus model predicts for the same regression. Okay, now this solid light yellow bar or golden bar, it reflects all these solid light yellow golden bars. They reflect the empirical regression on the 10-year yield. Okay, and of course the hatched golden bar, it is the model Gauss plus model predicted coefficient based on the 10-year regression. So let's walk through some of them. Of course, we'll not discuss all the coefficients, all the numbers, just some key observations we can have. See, at the 1-year maturity, if you see, the coefficient on the 2-year yield is strong and quite positive, both empirically and also in the model. Whereas for the 10-year yield, if you see, both the empirical and model coefficients are negative, which indicates an inverse relationship, which makes sense also, right? The 1-year yield will, of course, depend more on the 2-year yield and will depend much lesser on the 10-year yield. And in this case, in fact, we have a negative relationship. Very interesting. Now, as you move further out into the curve, you can see that these are going down. The brown ones and the yellow ones are going up. Okay, so the influence of the 2-year yield is steadily declining, and by around you can say the 10 to 15 year range, maybe 15, 17-year range. Okay, 10 to 15 year. Sorry, 10 to 15 year range only. Yeah, 10 to 15-year range after 10 years, it has actually become negative if you see. Okay, so it suggests that long-term yields begin to move in the opposite direction of the short-term rates. This is a very important insight when you are studying the yield curve. Now, at the same time, you look at the 10-year yield influence. Its coefficients steadily rise. It was a negative coefficient earlier, and now they steadily rise and they become a dominant driver for long-term maturities, which makes sense also. And you can see, in fact, they have become so dominant that around around this mark, if you see between the 15 to 30-year mark, they are maybe hovering around 1.1, right? So this tells us that the long-term yields are quite dependent on the changes in the 10-year benchmark yield. Okay, you look at the coefficients also. Let's take the 3-year yield. A 3-year yield is actually, if you see, it is having a coefficient of approximately 0.9. Okay, on the 2-year yield, and only around point, say, a little bit more than 0.2, 0.22, 0.23, something like that on the 10-year yield. But if you see the 15-year yield over here, of course, the roles will be reversed. You have a negative coefficient, okay, negative coefficient on the 2-year yield, maybe negative, it's just less than negative 0.4. And of course, a very strong positive 1.1 or 1.15 type of coefficient on the 10-year yield. Okay, so in the first stage of this estimation, we are choosing the alpha values which allow the Gauss plus model to reproduce these regression coefficients as closely as possible. As closely as possible. This works because these coefficients are only influenced by the mean reversion structure and not by volatility or randomness. Okay, we are only talking about the mean reversion speeds right now. So this allows us to isolate the mean reversion speeds with a high degree of precision. Now here's what's really impressive about this model. If you see the hatched bars, both the golden ones as well as uh, the red ones, the brown ones, you can see this is actually a visual validation. It actually confirms that the Gauss plus model, uh, even with just a few well estimated mean reversion parameters, is able to mirror the actual structure of interest rate movements across maturity. You see, there's very little difference between the hatched and the solid lines. Solid bars and the hashed bars, very little difference. Okay. So while the regression coefficients, this is where I told you that there is a problem because GARP and the chapter does not tell us directly how the uh, alpha R, alpha M, and alpha L values are derived. It actually talks more about the regression coefficients over here. So while the regression coefficients themselves are not directly equal to alpha R, alpha M, or alpha L, they actually serve as targets. Okay, and this is where I think GARP should have given more clarity. So this part has been completely excluded. So you need to understand this part, which has been completely excluded. They are not the parameters themselves, the coefficient. They actually serve as the targets. So Gauss plus model actually adjusts its mean reversion speed until the model implied regressions they match the observed ones. So which is you can say essentially like reverse engineering the best fitting alphas from market behavior. Now, this actually, when I was going through this chapter for the first time, I mean, I was a bit, I mean, although of course there are a lot of limitations, a lot of, sorry, advantages of the Gauss plus model, and the validity part is quite good. We can see there's very little difference between the solid ones, solid bars, and the hashed bars. But I was thinking something which probably I think you might also be thinking. Uh, you will be saying, okay, wait a second. We just saw how the Gauss plus model parameters, the alpha R, alpha M, alpha L, were estimated by tuning them until the model's output match those observed regression patterns. That is what I also thought. Okay, and again, no clarity from GARP over here. No clarity at all. So, to be honest, I mean, the question is quite good, right? Because if you see, you are actually matching, the model is matching the regression coefficients. So isn't that inevitable if you are reverse engineering the parameters from the same data? Is it is it really something worth applauding? Okay, so that's why I'm saying it's a great question, but we should analyze a little bit over here. And this is where I did some research, okay, to analyze it theoretically, that why the Gauss plus model is then so great. Because see, uh, we are right in this sense that regression coefficients are used as calibration targets. So the model's parameters, the alphas that we are talking about, they are deliberately engineered to match them. Okay. So if you remember, when we talk about validation, we have done machine learning also in FRM part 1. So this is not a validation in a pure out of sample sense. Okay. This is reverse engineering. This is not a validation in out of sample sense. You're not testing the model on something it hasn't seen yet, right? But here's why this step still matters and why it is still considered a genuine achievement of the model. See, first, not all models can do this. Even when you try to calibrate them, let's say we talk about the Vasicek model. It only has a single factor, the single alpha, which drives all the interest rate movement. So no matter how much you tune it, it simply cannot replicate the differences we observe between the short term factors and the long-term factors or the short-term yield behaviors and the long-term yield behavior. It does not have that flexibility. The Gauss plus model, on the other hand, with its three-factor structure that we have seen and the triangular kind of mean reversion, is actually quite rich. Okay, in fact, it is rich enough. It is rich enough, if I may say, to match the entire surface of the regression coefficients, empirical regression coefficients, because the difference is quite less. Okay, so the real success here is not just in the fitting of the data. It is in the fact that the model architecture itself is capable of doing that with only three mean reversion parameters. Okay. Now, second part that you need to understand, that we are not tuning to every single maturity. We are tuning to structural relationships over here. You need to remember, see, we only have three alphas, right? Alpha R, alpha M, and alpha L. But we are trying to replicate how yields behave across 30 different maturities from 1 to 30. And yet the Gauss plus model is able to closely mimic that entire pattern. Okay. So again, if you remember PCA kind of thing, right? Dimensionality reduction. So this is like a classic case of a low dimensional model which reproduces a high dimensional behavior. And that too, it's actually interpreting the structure also quite nicely. Okay. So this is not something that we just get for free. That is the, I'll say, advantage or payoff of designing a model structure which reflects real economic intuition. What intuitions? Short-term central bank reaction, medium-term monetary policy transmission, then long-term macroeconomic trends, risk premium, all those things. Okay, so all these intuitions are realized in the model. And if you understand, see, this is just a estimation stage. Okay, it's not about this, the estimation. We also have the next slide where we'll discuss the matching of the term structure of volatility also across maturities. And it only uses two volatility parameters, sigma m and sigma l. And only by using two parameters, it can match the entire term structure of volatility. Okay, so yes, the model parameters are calibrated to fit the empirical behavior, but we need to appreciate that the model can match those patterns with just a few inputs. And those inputs also we can interpret them, right? And many standard models can't do it. Okay. So that is the difference between, you can say, curve fitting and structural modeling. Over here, we are doing structural modeling. We're not just mimicking the data. We are trying to understand why the curve move the way it does using the Gauss plus model. And this is where I would have appreciated if this kind of clarity would have been provided, because when you read the text from Gar, there is this entire thing is missing actually, and you might get confused into believing that you're actually estimating the parameters from this learning objective. No, actually, it is all about coefficients, and then you are validating it, and then you are making your interpretation. Okay, the mathematical process, the optimization process has not been shown. Okay, which is true for most of the part two chapters in terms of numerical derivations, right? Now, let's see, as I was saying in the previous slide, that how well it captures yield volatility across different maturities. That also we need to see. Now this bar chart, it is again showing how the volatility is changing with term, and this is known as term structure of volatility. Okay, so on the x-axis we have the term 1 to 30 years, and in the y-axis, sorry, what happened to the pen? Yeah, sorry. In the y-axis we have, sorry, there's a problem. I think it has stuck. Just give me 1 minute. In the y-axis we have the volatility. Okay, and this is annualized volatility measured in basis points. Okay, so for each maturity you have two bars over here. You have the brown bar, which represents the empirical volatility derived from historical data, and you have the light yellow bar. It shows what the Gauss model predicts after calibration. After calibration, mind it. Now here's the important part. See, volatility, as we know, it's not constant across maturities in the real world. It rises sharply from the short end, peaks somewhere between the 17 and 20-year mark, you can see. And then it kind of levels off for longer maturities. And what you see here is how the Gauss plus model also replicates this quite closely, right? You can see this hump, right? This hump is over here. Okay, around this I'll say more than intermediate, around these maturities, 15, 17, 20-year maturities. Okay, the ability to match this pattern is not just accidental. It is the result of building a very solid model was and carefully estimating these three parameters: sigma m, sigma l, and then rho. Okay, these parameters are then optimized using historical volatilities and market implied data. And of course, they are adjusted so that the model predicted volatilities and the correlation values, they match the actual ones as closely as possible. And again, this is the logic again follows from the previous slide. We are doing some reverse engineering. We are doing fine tuning a little bit. Okay. But by after fine tuning, if we can get the shape that is implied by the market, what else you can ask for from a model, right? Okay. So it's not only about the level of volatility. You see the curve also, the shape, the curvature also is getting fit. So Gauss plus model structure is doing what it's supposed to do, right? It's capturing the real dynamics of the yield curve across all maturities. Okay, and the last part of this learning objective, the final slide for today, the final parameter to estimate. No, sorry, the second last slide, because we have a table also, as I said. Uh, I think I select two graphs and a table. No, two graphs, then this mu part, because mu part has been discussed separately, and then we'll have the table with the values, with one of the regressions being done. So the final parameter to estimate in our Gauss framework is a mu, the value to which the short-term interest rate reverts to in the very, very long run, you can say. Now, unlike the speed of mean reversion or volatility, mu is not directly observable from regression slopes or short-term dynamics. Okay, so we have to take a structural approach. We estimate mu by minimizing the sum of squared errors, SSE, we discussed this earlier, between the observed market yields and model implied yields across all maturities and the entire sample. Okay, this ensures that the long run level implied by the model is not only, I'll say, internally consistent, but also explains best the full cross section of all the observed yields. So basically, you are finding out the yield which actually makes the model shape of the yield curve most faithful to reality, you can say. Okay, without overfitting short-term noise. Okay, and it is like a global data-driven anchor for the yield curve. Okay, the mu. And finally, we have the last slide. So following whatever steps we have seen, this table actually summarizes the final calibrated parameters of the Gauss plus model using US Treasury zero coupon yields from 2014 to 2022. So very intense regression was carried out and these parameters were estimated. Okay, so let's start with the mean reversion parameters. We have to interpret them. Of course, you can see alpha is highest. Half-life is, by the way, in years. I just want to give that to you. Half-life is in years. And if you don't remember, do you remember what is the meaning of half-life? If you don't remember, I'll just, what does it mean? Half-life means that the time it takes, I mean, we have done half-life earlier, right? The time it takes to cover 50% of the distance, right? So if suppose the short-term rate is far away uh, from the from its expected value or the value which it is supposed to take after some time, then in how much time will that distance be covered? The 50% of the distance will be covered. That is your half-life. Okay. So alpha R, you can see it is the highest, which means that the short-term rate responds quite quickly, which is quite consistent with monetary policy adjustments. And of course, the associated half-life of 0.66 reinforces this, right? Because the faster you are actually reverting, the rates are reverting, the lower the half-life will be. Alpha M is next, which governs how the medium term factor reverts, 0.6358, and 1.09 years is the half-life. Alpha L is very, very low, slowest by far. It clearly it reflects, we said, na, gradual adjustment, very slow gradual adjustment. So this reflects a gradual adjustment towards the long run level mu and a very, very high value for half-life. Now, these volatility estimates are also quite meaningful. You have sigma m as 109.2 bps and sigma l as 96.4 basis points. Okay. So these drive the term structure of yield volatility, which we saw earlier. Okay. So despite high factor volatility, sigma m, the mean reverting nature dampens the overall yield volatility. And you have rho. Rho is estimated to be 0.212. Finally, the estimated mu is 10.555%. Okay. While this might appear a bit high, it is important to note two things before we conclude. The first thing is that the long-term factor reverts extremely slowly. So this mu has very little short-term impact. And finally, this long-run value includes a risk premium. Okay. The details of which are not discussed. You need to understand, you need to remember that the long run value includes a risk premium. Okay. That brings us to the end of the lecture, Vasicek and Gauss plus model. So we started with the fundamentals of the Vasicek model, the structure, the assumptions, limitations, everything. And then we transitioned into the Gauss plus model, which we saw that it builds on the Vasicek model by capturing, the interest rate dynamics in a more realistic way, introducing more factors, by the way. So the mean reversion, stochastic components, dynamic volatility, a lot of things we discussed, improved curve fitting. Okay. This is much more powerful. The Gauss plus model was much more powerful than the Vasicek model. And both these models, by the way, the Vasicek as well as Gauss plus models, okay, they both form an important foundation for modern interest rate modeling. Of course, Gauss plus is more used for more complicated applications, but still you can use Vasicek for simpler models, whether you are pricing bonds, okay, or maybe simple derivatives. You can use the Vasicek, but for complicated ideas, you should always go for Gauss plus models. Okay. Okay. Thank you very much, everyone, for attending this lecture. I'll see you in the next lecture. Until then, I'll say stay curious and keep solving questions. Thank you.